Hello, welcome to Real Estate Market Analysis, Market Data for Retail Space by Dr. Melissa Cohen. The learning outcome of this brief course is to learn how to apply market analysis concepts in retail type real estate. We are also going to conduct a market analysis, and specifically we're going to examine market data such as demographics, economic characteristics, lifestyle characteristics, and we're going to look at supply and demand for retail space. Now this brief conversation, discussion, lecture is going to be ideally for anyone working in commercial real estate where they're looking for new spaces. So this can also be for real estate brokers who want to actually put tenants with landlords. It can actually be tenants such as Fortune 500 companies or any business wanting to open a new retail space. And it's also valuable for landlords when they're trying to look at who can be attracted to their space that they have. They need to know, well, what is the other person thinking? What is the tenant and potential buyer? What are they thinking? What are they looking for? What type of data are they coming to the table with? And then that way, as a landlord, you know how to present the best front for your property. And obviously, if it's the better fit, you can command more money. And as far as maybe either purchase price or rents. Now, when we look at the overall site selection criteria, we can basically put it into three buckets here. One is location, site feasibility, and that's what a lot of real estate managers are more familiar with. They look at, okay, does this location, does the physical address, does the physical building, is it located next to other people? Do we need, is there a road? What are there lights going in? Turn lights, signal lights, that sort of thing. What shape is the building in itself? And so they take all of these factors into consideration. The second overall bucket, and we'll go into more detail in a minute as well, is a market analysis. And what that means is you look at who are the people in the area. And the people can be described by many different characteristics, and then the area itself can be described by different characteristics. Is it driving area? Is it, how big is the trade area? Is it 1 mile? Is it 20 miles? Is it 50 miles? Then you're going to look at maybe income, like who lives there, and is our ideal customer for our retail space, do they live in this area? And then the third bucket is financial feasibility. So even if you have the perfect site and you have your customers, a large portion of your core customers live in that area, you have to make it a financially feasible deal for both the landlord and the tenant, or the seller and the buyer. And if it doesn't work out, then it's obviously not going to be a good space for either party. Now, one thing I like to bring up is Field of Dreams, just because it's from the movie starring Kevin Costner. It came out, I don't know, in the 1980s or 1990s. But one line that sticks out for me is, if you build it, they will come. And that was a little mantra of the movie. Now, obviously, that's not true for commercial real estate. So I do want you to be careful that just because you build a building doesn't mean that you're actually going to fill it, and fill it with tenants and be profitable as well. So that's also illustrates why it's very important that you have those three buckets working together and coinciding in a nice bubble, your own little bubble there. Okay, so moving on, we're going to look at what is the reality of the retail market. So first of all, you always know there's going to be a shift of consumers buying online. And also, therefore, if they're buying online, they're not actually physically visiting retail stores. Now, I'm recording this in the middle of the COVID global pandemic, and so this statement is more true today than it was a year ago when I first made this presentation. And because consumers have been forced to buy online. So even if it was not their preferred shopping pattern, they have been forced to, or a lot more people have been forced to than they wanted to. And so there becomes a normalcy to that. There becomes a trust factor to that. There becomes a new pattern of living that wasn't there before. And also, with that buying online is traditional retail chains are closing stores. And so every year, I think since the 2008, there have been major chains who are either closing completely or they announce large closings, large number of closings, just because of the shift in consumer buying patterns. So let's look at a quick scenario here. So let's assume that you are the VP, the Vice President of Real Estate in a corporate office. So your budget allows you to open 2 new locations, 2 new retail stores anywhere in the U.S. Now, obviously, once you publish that you're a VP of Real Estate, whether LinkedIn or any organization or even with your company, you start getting a lot of unsolicited information, including flyers, property flyers, versus whether they're actual paper flyers or a lot of information via emails and such. You're going to get this information from brokers, landlords, and developers because they're trying to sell you their site, like come to our site. So if you are the VP of real estate, how do you choose the best 2 sites to grow your business? So the one thing to consider, another thing to consider as a VP of real estate is that you're not just simply finding the best real estate site, the best looking building. You're looking for the best looking building that meets the needs of your consumers, your customers, at the best financial price. So we've got those 3 buckets that you have to consider all things together. Now, if we go on, and what we're going to do is go ahead and take a few minutes to dive into market data and look at that market analysis specifically. So these are the most common factors that affect commercial real estate. They look at demographics, they look at economic factors, they look at lifestyle factors, and we look at simply the real estate supply and demand. Now we're going to take a few minutes and go into each of these factors individually. So demographics, it basically means to describe the people. Now the typical information is, what's the population size? What is the average age? Does it skew older? Does it skew younger? What is the race mix up? What is the race mix as far as, what is the race? What is gender? What is the main type of occupation for that area? What is the household statistics by income? You can also find out education level as well. And, tenure. Do they own? Do they rent their homes? And also the house value. What is the average house value for a specific area? Now, most of this information can actually be found on the U.S. Census Bureau website. Now, each retailer has its own criteria for demographics, property data, and site location. So that's a side note. So typically older companies or that have been around for a while, they know, they should know and have data to prove who their core customer is and where their core customer shops and what type of markets and such. So they are going to come to landlords with that information, or real estate brokers with that information, and that because they already have that proven information. So I'm going to take a look at 2 stores, competing stores by 2 different companies, but that sell basically the same type of goods. And the first one is Family Dollar, and this is one of their newer pictures and such of what the exterior building looks like. So let's give some information here. So their site criteria, and it's listed on their website, is conveniently located to value-oriented, low to middle income customers. They would like to be with a food store anchored neighborhood shopping centers. They like to be in convenience strip centers, freestanding buildings, or storefront locations. So basically, what do they exclude? Well, they don't want to be in high-end shopping centers, right? They said neighborhood shopping centers, convenience strip centers. If there's 4 or 5 businesses in a strip center. They would like to be multiple site developers are welcome for freestanding build-to-suit opportunities, and the locations must be within their 46-state operating region. So some general information, not too specific at this point. Now, if we look at one of the competing stores with them and companies, it's Dollar General, and this is what, one of their typical neighborhood or strip center retail location storefronts look like. And their site criteria is they have a 1 to 5 mile trade area. They would like to be on the right side of the road on the way home with an easy turn in. Their income with the household is less than $75,000 annually. They actually like to be in population density of around 5,000 within the 1 to 5 mile trade area. They do recognize that their customers are primarily female. They do have dual income homes, so that means that at least mom and dad or husband and wife or two people actually work, and basically low to middle income, typically less than $75,000 annually. And their customers demand convenience, value, and they still want a pleasant shopping experience. Now, if we look at a retail chain on the opposite end of what these dollar value-based companies are, we have Nordstrom. And one thing that we know is they target middle to higher income, and this is just kind of what when their store entrances look like from a mall entrance, and you can obviously tell that it is much more luxurious than what we saw with the Family Dollar or Dollar General storefronts. So their site criteria is the prototypical site ranging from 30,000 to 40,000 square feet. They would like to be located in a super regional suburban environment that complement the positioning of existing full-line Nordstrom department stores. They actually want to be located in upper income communities with at least 200,000 people that are highly educated within a trade area. Now, they don't define the trade area, but let's say 10, 15 miles because they want to be like in a larger mall or a larger outdoor mall, a high-end mall area. And they prefer to be co-tenants with other fashion and soft goods merchants in a strong community or power center environments. So those site criteria obviously is very different than what you find with the Family Dollar and Dollar General stores. Now let's move on to the next criteria that we look at. The factor is the economic characteristics of the area. This provides insight into the nature of the demand for the space. So we are going to look at employment data. That's specifically what characterizes economic characteristics. So specifically, we're going to go into a little bit more detail here about workforce characteristics. Also, we're going to look at the type of employment and also the total employment for the area. So the next item to look at is the type of employment. And you can find the employment categories through the Department of Labor, and they're divided into, they call them SIC or NAICS codes. And so, for example, just to give you something you want to look for is construction, and then that can be broken down into finance and insurance, real estate. There's also a different category called professional, scientific, and technical services and such. Now, the next slide here is about total employment. What we're looking at here is the total amount of employers, the employees, and the earnings in a specified area. So you also must consider that the spending power must support the store within the trade area. So there may be a large number of people, but the earnings may be low, and that may not be your target market and therefore not support your retail store. So some things you can look at within this category are how many people total, how many people employed, and what is the average household income. And you also want to look at what is the average household income in the trade area that you're looking at. So here's an example. So would you build / lease a Ruth's Chris Steakhouse in the middle of Iowa? Probably not, because you would think that the trade population or the amount of people that living in the trade area are not going to be wide enough to support that. Okay, so we're going to just look at it from this standpoint here. So now look at another example. How about a dollar sector store? Would you build one of those in the middle of Iowa? And the answer is yes, because actually if you drive through there, you'll find some several Dollar General, Family Dollar, Dollar Tree, those type of stores as well. So let me give you another example to consider. So let's look at two trade areas. One is a blue collar and the other one is white collar workers, but they still have the average household income of $80,000. So which demographic though is more likely to shop at Nordstrom for clothes? And then which demographic is more likely to shop at TJ Maxx? We are generalizing here. So typically the blue collar workers would shop at TJ Maxx and maybe the white collar workers would shop at Nordstrom. Now another characteristic to consider are lifestyle characteristics. And these are intangible of a local economy, but they affect the population size. So this information may not be readily available through the Census Bureau or anything like that, but that's why it's also very important, if you're a real estate agent or a landlord or somebody like that, or a retail person, corporate, to go to the area and get a feel for the area. So you're going to look at what are the recreational opportunities. You're going to look at what are the intellectual and education opportunities. So obviously with educational opportunities, you can look at how many colleges and such are in the surrounding area. Intellectual, you can see, is there any small business development centers? What's the Chamber of Commerce like? What other things support businesses and education? You also can look at trends and values. You can just, depending, I don't want to generalize by what state or by what region of the United States, but you can get a little bit of sense of what the values and trends are. And also look at community identity. One thing is, are there local coffee shops? Are there more chain stores? Are there more local restaurants? If you walk in, and what's hanging on the billboards of these locations? What's at the front entrance of the local grocery store? Like what type of magazines are there available? So some of this stuff you can find by just walking around and getting a feel for the area as well. And just to give you some thought here about what are some lifestyle examples that vary by area. At Vail, Colorado, they're known for attracting outdoor sports and recreational activities. Skiing, obviously that's a big factor there. However, on the flip side of weather, we're going to look at Orlando, Florida. In that general area, middle or central Florida, they attract amusement parks. Also, it's family entertainment. There's, the Disney, there's Universal, there's Gatorland, Legoland, all kinds of extra activities in that area for family entertainment and vacations specifically. Another thing to consider is that colleges and universities attract a more educated population. And one thing to consider is artists may be attracted to a particular neighborhood. And I think you can kind of get the feel of that when you walk around and you see what types of shops are available and whether the buildings themselves, do they have any street art on them, or are they just your typical commercial buildings? And another lifestyle example is Austin, Texas. They're known for the research and technical expertise. So depending on where you are going as a retailer, or if you're the landlord building buildings, you need to know and be aware of who you're more likely to attract to your particular city. And one more factor to consider is simply economics, the supply and demand. And specifically with real estate supply and demand, you need to look at what is the total inventory square feet, right? How much is out there in that market? How much is vacant? Obviously, you're going to have some vacancies just because businesses open and close. Just part of the business climate, should be normal. The other thing is, if you have a couple 500 square feet, 1,000 square feet spaces in different buildings, in your typical office space, someone needs 3,000 square feet, you're going to have a lot of these little square feet chunks left over. So that, even in a great market, you're going to have a little bit of a vacancy just because the space doesn't quite meet what somebody needs. The other thing to consider is absorption rates. And that's how fast are these spaces being taken. So if it's a a particular space, let's say it's just been on the market for 3 years, but if it's a space and it's a great building and a great location, then it's going to be absorbed and turned over fairly quickly. Another thing to consider as you drive around is to look at what's in the development pipeline. So if a corporate headquarters is currently leasing a building in a prime location, but or you've heard or read or researched that they're actually building a brand new headquarters because they're growing, and instead of having 3 different retail space office space at 3 different buildings, they're going to consolidate and open a brand new building. Well, when that happens and they move to their new building, you're going to have all this excess space open up as well. You also need to know what's being built, because you need to know who's going to move to that new building, right? Are they going to take any potential tenants as well? And also, what are the rental rates? So depending on what type of building it is and where it's located, obviously they can charge more than someone that's in Class C space that's been around for a while, is not in the most ideal location as well. The next factor to consider is competition. Where are they located at? And one thing, this is a twofold or a double-sided question here. Where does having more retail stores clustered together encourage more shoppers, or does it actually take sales away? So you have to think about what your business is and whether that's a good thing or a bad thing. One thing are restaurant rows. Typically that's a positive thing. Actually, if you have a bunch of restaurants together, more people are encouraged to go out to eat. And yes, it's competition, but it's also encourages shoppers to go out, or eaters to go out to eat as well. And another thing to consider are having specific co-tenants a good thing. So do you want to be linked in your real estate lease to a co-tenant, or do you just want to stand alone and your sales depend on yourselves? All right, so another part of that is adding space. So obviously I gave an example earlier about corporate headquarters. If they relocate to a new city and they build a new building, that definitely happens. What if a developer builds neighborhood retail strip center? So it can probably be a smaller space, but if it can house 6 to 10 more small businesses, then that may be a great thing for that community as well. And another thing to consider are the dollar sector stores. They build new buildings and they have rapid growth plans, both for the companies, the Dollar General and the Dollar Tree stores, and they obviously still own Finley Dollar stores as well. So they're looking, they're 9,000 square feet roughly, so they can open those buildings fairly quickly, and they've got that down to a science. So is that going to serve your community well or not? And the other thing you always have to consider is removing space. Space actually goes off the market when you're talking about your total vacancy and what's allowed. Obviously, natural disasters are unexpected, but yet they do have a severe impact on commercial and office retail space that's available. Example is Nashville, Tennessee had a flood of 20 in 2010. Closed the Opry Mills Mall for over 2 years. That was a lot of 1.2 million space of retail space taken off the market. 17 anchor tenants and over 200 other stores. Another reason or cause for removing space is that it's demolished for future development. So someone came in and bought it and they don't like how it's set up, so they demolish it and then they're going to redo the space completely. And another reason is it becomes old. Space becomes obsolete due to vacancy. Maybe it's in a part of town that nobody, the people have moved away from, and retail and other office spaces have moved away from, and it's just no longer necessary. And so after a while, buildings don't last forever, and so they do just become obsolete, because if they're just empty and nobody buys them. So let's summarize. This is a very quick summary here. So just remember that there are many, many characteristics that influence commercial real estate demand and supply as well. And some of those characteristics, briefly, once again, are demographic. You want to also take a look at and do your analysis on the economic characteristics. You also want to take a closer look at lifestyle. Who are the people that actually live in that area and what are they like? And simply going back to the basics of your real estate supply and demand. What's in the market, who's in the market, what's available, what's not available, what are the current prices and such. So I do want to thank you once again today. My name is Dr. Melissa Cohen, and I hope this presentation has given you a brief yet somewhat detailed market analysis and how to determine the best space in commercial real estate, either retail or office space for your business. Thank you for joining me.